obviously, yeah. But she was like, when I look at her pictures stuff back in the day, you know, my sister's skinny, and then nah. But you're not too big. Oh, so it's like I can still put it in my family. I can share my grandma. Yeah. No, my mom was. They are very big. No, my mom is skinny.
All right. Don't mind this, ne? Yes, yes. She's connected. So the screen that we are seeing here is exactly what she is able to see as well. Yeah. So don't mind about just it's just for them to hear me clearly. Otherwise, if I use that desktop microphone, it's gonna have these echoes and all that. Yeah. All right. So we're going to be looking at October, November 2018. October, November 2018, past exam paper. October, November 2018 paper.
So as we ask questions, will she hear us?
It's fine. What she will do, she will also put, I'll tell her to put comments. All right, and then I can be able to see them, and then we'll able to. All right, so maybe before we start, remember we are now preparing for the exam, and the best thing I need you to, the best attitude that I need you to adopt now is just to. This paper is not as difficult as you think it is. It's something that you can handle. Ne? So you just need to be okay. Whatever that we are going to be applying here is basically what you're going to be applying in the exam. All right, so everything is going to be fine. Just like I said, we're going to do it in a way that it's going to be impossible for you to pass the paper. Ne? Yeah, so I'm going to be touching mostly on the aspects that I know, like definitely this is what you're going to have in the exams. Like for example, we're starting with capital budgeting. We know with capital budgeting, it's definitely coming in the exam, right? And most of the questions are based on that. All right. So with capital budgeting alone, just like I was saying last time, when I would look at the other past exam papers, you'd find that just by mastering capital budgeting, right, already you are at 50% plus, right? And capital budgeting is what we were practicing last time, the present values, discounting using time value of money and all of that, right? So I just want to confirm if Madre is connected. All right. Yeah, she's connected. All right. All right. So just calm down. We're going to apply everything, and then we'll take it. We'll take it. We'll take it. We'll take it as it comes. So let's look at quickly question 1. I've also typed the questions so that you are able to see on the board or on the screen as others are tuning in online. So question 1, let's quickly look at question 1. This is a capital budgeting question, right? This is a capital budgeting question. It's saying consider an investment with the following year-end cash flows. Consider an investment with year-end cash flows. We have end of year, and then we've got year 1, year 2, year 3, and then we've got cash flow, 20 rands, 30 rands, and 15 rands. So that's for year 1, year 2, and year 3. So let's check what question 1 is asking us to do. Using a 15% interest rate, convert this series of irregular cash flows to an equivalent in present value terms, a 3-year annuity. And that's how many marks? 8 marks. So already when you know that, when you see a question like this, you already know that these are marks that you're just going to put in your pocket, right? It's an easy question that you don't really need to be scared about. All right, so this is the answer that I have there. I've presented it in form of a table. So your table, right, this is more like the generic form or the generic format of your table, right? Just like I was saying last time, you'd find that other students, they get to fail because of just the format, right? They are able to understand the question. They even know how to apply, but now the format of the table and everything is going to take much of their time. So always when you find a question like this on capital budgeting, always adopt such a format, right? You could present this answer in other formats and all of. There are many other formats that you can always apply. But now I want you to adopt this so that I know when you go into the exam, you're just going to apply this. So it's going to save your time, right? Just have a column of the year, have the column of the amount, have the column of the calculation, because your examiner wants to see where you're going to be, where you're taking your answers from. And then you have a column for present value at 15. In this case, we are looking at 15%, remember. Our discount rate is 15%. All right. So let's look at the question again. Using a 15% rate, convert this series of irregular cash flows to an equivalent in present value terms 3-year annuity. So first and foremost, if you look at this, in year 1, at the end of year 1, we are receiving 20 rand. Yes. At the end of year 2, we are receiving 30 rands. At the end of year 3, we are receiving 15 rand. Right? Now, that's why they are calling them irregular cash flows. They are not the same. If they were the same, we were going to call them an annuity. Right? So now we want to convert these irregular cash flows into a 3-year annuity. All right, there is a call coming in. All right, sorry for that. So first and foremost, we need to first find the present value of these cash flows that we are given, right? So if you check in my calculations, I've got let's look at year 1 for 20 rand. I'm going to be using the present value interest factor at 15% for year 1, right? That's basically, I know you are now used to that, right? You need to then go to your tables, a question noted, ne? You go to your tables and you pick the factor from there. Remember, you go to table 2. Why? Because the amounts are different. Yes, the amounts are different. We've got 20 rand, 30 rand, and 15 rand. So it means always when the amounts are different and you're trying to discount these values to their present values, it means in this case you're going to use table 2 always. That's a rule of thumb, right? Table 2 when the amounts are different, and you use table 4 when the amounts are the same, right? So in this case, the amounts are different, and we are trying to find the present values. So it means we are going to be using table 2. So when you go to your table 2, at the end of your textbook, you look for a column that has got 15%, because remember we are using the discount of 15%. And you look at, you're going to go to row 1, right? Where they intersect, the column and the row, where they intersect is where you're going to find the factor there. It's where you're going to find the factor. In this case, it's going to be 0.870, right? And then you multiply that factor with the amount that you are given. In this case, it's 20 rand. And then our present value for year 1 is going to be 17 rand 40 cents, right? So remember the 20 rand was received at the end of year 1. So it's like we are discounting it to now, right? And then the value that it has now will be 17 rand 40 cents. And then year 2, we do the same, right? We look for the factor, but in this case now, you go to the column that has got 15% and the row that has got 2. Where they intersect is where you're going to find that factor, 0.756. 0.756. and you multiply that factor with 30 rands, and then you will get 22 rand 68. That becomes the present value, right? Year 3, you do the same. The factor at 15% year 3, and then you will get that factor 0.658, and then you discount it to the present value of 9 rand 87. All right, and then when you're done, you're supposed to add. All right, you're supposed to add all the present values. Don't forget what the question is asking us to do. Right, the question wants us to convert the series of irregular cash flows to an equivalent. We want to convert these irregular 20 rand, 30 rand, and 50 rand into an annuity, a 3-year annuity. You get the idea? So the first step is to actually first convert all the amounts into their present values. So you then add the figures from the first one up until the last one, and you get a total present value of 49 rand 95 altogether. Right? So that's step number 1. Then after that, you convert that 49 rand 95 into an annuity. Right? That becomes your overall present value. So you're going to convert it into an annuity. Remember, it's a 3-year annuity because we have 3 years.
Yes.
Ne?
Yes.
All right. And then how do you then convert that present value into a 3-year annuity? You use that formula that I have there, right? Equivalent 3-year annuity. The formula is present value over the factor. But remember, this factor, it's not an interest factor that we find in table 2. It's an interest factor that we are going to find in table 4. Why? Because remember, we want to now convert it into an annuity. So now the formula again, it will be present value over present value interest factor annuity. Right? Present value interest factor annuity. The moment you see that PVIFA, you know that it's table 4. Right? If it's going to be PVIF, just PVIF, that's table 2. Right? PVIFA, that's table 4. Right? So we have the figures already. Right? The present value is the one that we've just calculated now, 49.95. Right? We divide that by the present value interest factor annuity at 15% year 3. So it means you go to table 4. If you go to table 4, you find the column that is 15% and the row that has got 3. Where they intersect is where you're going to find that factor there of 2.283. Do we find that figure? You just divide the 2, 49 rand 95 divided by 2.283, and you'll get 21 rand 88. So 21 rand 88, that becomes your annuity. That becomes your annuity figure, and that's what the question wants you to actually come up with. Yes, a question.
So if the question had just said, using the 15% interest rate, calculate the present value of these irregular cash flows, then you don't have to do the annuity.
Yes.
Just end up to 49.95, then we do the NPV.
Okay. Just to also let the other guys who are joining us online, Tepiso is asking if the question only wanted us to calculate the present value. She's asking, was there a need to actually calculate the annuity and all of that? There won't be any need because the question is only asking you in this case to calculate the present value. So once you are done with the present value, you are actually finished with the question. Yeah, you're actually finished with the question. But in this case, it wants us to convert the irregular in the sense that they are not the same. So it wants us to convert that into a single amount, which is the same throughout. So in other words, in this case, instead of saying now, year 1, 20 rand, year 2, 30 rand, and year 3, 15 rand, we are now just going to say 20 rand 88 for the 3 years. Why? Because we have converted it into an annuity. So it will be 21 rand 88 for year 1, 21 rand 88 for year 2, 21 rand 88 for year 3. All right. So we have just answered our question. 8 marks for free. Amen. All right. Yeah. Any further questions on question 1? Any further questions on year 1? So you just need to know your time value of money concept. Ne? You just need to master it well. Just like I said, that the format of that table, right, would not normally change if you come across a capital budgeting question, especially the one that's asking you about cash flows and all. The moment you face a question that has got cash flows and all that, just have your table in that format. It's going to help you to structure your answer well and also be able to collect all your marks. And also be able to collect all your marks. All right. If there are no further questions, can we move on to question 2? Can we move on to question 2? All right. Question 2. Remember, I'm going to upload these slides on the online platform so that you can go and refer to the answers, and also the video you can replay and replay until you are covered. All right. Question 2. This question does not have anything to do with capital budgeting, right? But I thought just for the sake of it's part of this, right? Let's just handle it. I know last time we wanted to tackle it and we couldn't sort of finish because the assignment was coming and all of that, right? So this is not for capital budgeting, but I think it's going to help us in the sense that maybe next time when we say we are now focusing on this subject, at least you have an idea of what we will be talking about, right? So it's saying ExxonMobil expects its earnings and dividends to increase by 7% per year over the next 6 years, right? ExxonMobil expects its earnings and dividends to increase by 7% per year over the next 6 years, and then to remain constant, thereafter. The company currently pays dividends of 5 rand per share. Now, a question like this has to do with if you go into your and check your topics and study units, this has to do with valuation of stocks. Yeah, valuation of stocks. Remember, there is valuation of stocks and the valuation of bonds. Yes. So this is where we are now. In this case, we are looking at valuation of stocks. So if you look at what that question is saying, ExxonMobil expects its earnings and dividends. It is expecting its earnings and dividends to increase by 7% per year over the next 6 years. So the moment you see the word earnings there, where it's saying earnings and dividends, then you know that they actually want us to come up with a value of an ordinary share.
Earnings and dividends.
Yes. Earnings and dividends. Earnings and dividends. It actually wants us to somehow come up with the value per share of an ordinary share. Right? Remember, ordinary shares, if you buy ordinary shares, maybe within an organization or from a company, you become an owner of that company, right? So now every profit that company gets, it literally sort of belongs to you because you are an owner of the company. So now when the profits are added together, like previous years and all of it, they actually called earnings, all right? So that's why the moment you see the word earnings, you know, oh, they are talking about ordinary shares, right? So again, I'm going to repeat the question. ExxonMobil expects its earnings and dividends to increase by 7% per year over the next 6 years, and then to remain constant thereafter. The company currently pays dividends of 5 rand per share. Now, when you look at a question like this, right, the information that we are given mostly, if you look at the given information, it's talking mostly about dividends, right? It's telling us that the dividends are going to increase by 7% per year over the next 6 years. So from now up until 6 years, every year there will always be a 7% increment, right? And then after 6 years, the growth is supposed to remain constant until, right? So some shares, normally when they buy them, other people, they buy shares in order for them to resell them. Right? Sometimes some people they'll buy their ordinary shares in so that maybe after a certain time they resell those shares. But if you look at this question, it's silent on that. It's not telling us about any shares being sold or anything. It just tells us that the dividends are going to increase by 7% per year over the next 6 years and then to remain constant thereafter. So it's telling us about from 7% after 6 years, it's just going to grow at a constant rate thereafter. It's not telling us about shares being sold. So this is irredeemable shares. These are not shares that are bought for the purpose of reselling, right? Because there are other questions that will tell you that, and I'll tell you when we come across a question like that, right? You don't have to worry about it now, right? Just let's focus on getting an answer to this one. You just need to know that this one is irredeemable, right? The purpose for buying shares like these was not to resell them, right? So can we quickly move on to the answer? You see, the table that I have is more or less the same, right? I normally use such a table because it helps me to actually, structure my answers perfectly fine and well. All right. So let's look at our answer. It says.
So can we look at the required first before we go?
Yes, let's look at the required. Thanks for that. Let's look at the required. Determine the value of a share. Determine the value of a share of ExxonMobil to an investor with a 12% required rate of return, which is basically what we have there. Determine the value of a share of ExxonMobil to an investor with a 12% required rate of return. So already your discount rate that you're going to be using is 12%, right? But now let's analyze. Let's go into this question and understand each and every step bit by bit. Let's start with year one. So maybe before we go to year one, look at my table. Basically the same, right? Year, I've got a year column, I've got the amount column, I've got the calculation column, and I've got my present value, right, at 12%. Let's look at year one. Let's look at year one. If you look at my year one, previously we were told that, can I quickly go back to that part? The company currently pays, at the last part of that statement, the company currently pays dividends of 5 Rand per share. So the current dividend that the company is paying is 5 Rand per share, currently, now. I could even call it year zero. Remember, year zero, it's now, right? But now we're looking at starting from year one. So currently, now, the company is paying 5 Rand dividends. Ne? But from year one, at the end of year one, that's where the growth is expected. So how do I affect the growth? Look at what I've done in the amount column for year one, right? I've 5 Rand multiplied by 1 plus 0.07. What am I doing? I'm adding the 7% growth, right? And it's going to have to start from year one up until year 6, right? So that's the first one, 5 Rand multiplied by, in bracket, 1 plus 0.07. That's the first 7% growth. And then the total that I would get there will be 5.35 or 5 Rand 35 cents. Right? So that's what I should actually have in the amount column. Right? But where did I get that? I took 5 Rand, I added 7% growth, and then I get a 5.35. Why do we say 1 plus? Now, that bracket there, where it says 1 plus 0.07, we are basically putting into effect the 7% growth. Yeah. So another way you could do it, you could just, like if you have your calculator, you could just say 5 plus 7%, right? 5 plus 7%, and you should be getting 5.35 if your calculator is programmed well and all that, right? If you say 5 plus 7%, it should give you 5.35. But now, you wouldn't want to really put it like that. Your lecturer might penalize you for that. He wants you to really understand the concept behind. So what you need to do to effect that growth, you just need to say 1 plus 0.07. Now, 1 represents 100%. And the 0.07 represents the addition of 7%. So you're basically saying 5 plus that growth of 7%. But how do you put that into effect? Mathematically, you do it like that.
So it's a standard thing.
It's a standard thing.
A question like that, I must always forget rule of thumb, 1 plus.
Yes.
Percentage, whatever.
Yes. Yeah.
It's a
It's a rule of thumb. When they say, like when I would say, you've got an amount, let's say it's 10 rand, right? And I say add 10% on that 10 rand. You'll just say 10 multiplied by 1 plus 0.1. It will give you the answer straight. All right. So now we are fine with the amount, 5.35. Let's move to the calculation. Let's move to the calculation. So I'm now going to take that 5.35 and I multiply it by the factor, right? I'm going to multiply it by the factor because remember, this dividend was received at the end of year 1. So I need to discount it to now. Now, if you check those amounts from year 1, just look at them from year 1 up until year 6. Are they the same? They are not the same. If they are not the same, which table do we use? Table 2. So it means you're going to have to go to table 2 and you put it, your formula will be 5.35 multiplied by PV, that's present value interest factor, 12%, comma 1. So you just write it like that in the exam, right? PVIF, that's for table 2, 12%, comma 1, which means year 1. And then you go to your tables where they intersect, the column and the row, is where you're going to get that factor of 0.893. 0.893. All right, then you multiply the 2 and you get a present value of your dividend at 4.78. Remember here we are dealing with a dividend, right? These are the dividends that we are receiving, and we are going to find the value of this share based on the dividend alone, right? So we are done with year 1. Year 2, look at what I've done. I've taken 5 rand. I am multiplying 1 plus 0.07 and I've squared it, right? In other words, I'm saying literally it's like I'm taking 5.35, right? That's the other method you could use. You take 5.35, you multiply by the same 1 plus 0.07. But here, because I'm using the same amount which is 5 rand, 5. If you check with year 2 up until year 6, I'm using the same amount. So to put that into effect, right? To put the growth for year 2 into effect, I'm going to say 5 rand multiplied by 1 plus 0.02, and then I square that. Yeah, because it's basically saying the growth for year 1 plus the growth for year 2. That's what I'm saying.
So in effect, on year 2, under amount, we could have had it as 5.35 plus 7%.
Yes, that's another way of doing it. Right? So there are 2 methods in which you could apply here, right? I'm going to start with the method that I've applied. The method that I've applied, I'm taking 5 rand, the same amount, the same original amount, right? Just like the one that I have in year 1. I put the bracket multiplied by 1 plus 0.07 to the power 2. So I'm actually saying 5 multiplied by 1 plus 0.07 bracket, and I'm putting another bracket again because I'm now considering another 7% for year 2. So that's one method of doing it. Another method, which if it's easier, you can also apply that, is just to take the amount, the latest amount that you have. In this case, it's 5.35. You multiply it by 1.07, and you should get the same answer, which is 5.72. Yes. Yes. Then you're still able to come back. Yeah, so one has got advantages where if you're able to get it wrong, at least you you are quick to come back in line.
In the assignment 2, we had a question, when it had, I can't remember what it was, but where your closing balance for the 1 year will be your opening balance for the next year.
Yes.
It's almost like this, it's just that obviously here, because of the 7%, you have to add 7% to your closing balance
Yeah.
for your opening balance.
Yes. So you've got two methods that you could apply. Both of them, they are going to give you the same answers, but it's a matter of which one do you apply, right? What I'll do is on other questions, maybe when when we yes. Yes. Yeah. So you could apply it like this. At least you will be able to remember, okay, here I'm dealing with year 2, year 3, year 4, and then all that. So you do the same from year 2 up until year 6. Right. For now, forget about year 7. We'll deal with that one later. Right. But basically, the method that I've applied on year 1 is the same as year 2, year 3, year 4, year 5. Right. So I'm also applying the right factors. If you check, like for year 2, I'm having 5.72 multiplied by the present value interest factor, 12% year 2, right? So I just go pick the factor from the textbook and I apply it there, and my present value becomes 4 Rand 56. So remember, again, these are dividends. These are dividends that we are getting at the end of each year, and we need to discount them to now, because the question is saying find the value, right? Find the value of a share now. What is the value of that share now, given these estimated amounts for dividends? Okay, year 3, it shouldn't be difficult. Year 4 should not be difficult. Year 5 should not be difficult because we are applying one and the same, method, right? So now we have got our present values now from year 1 up until year 6. But now, if you go back to the question, it's telling us that that growth of 7% was expected for the next 6 years, right? But we don't stop there. It's telling us that, and then to remain constant thereafter. And then to remain constant thereafter. In other words, after year 6, there's not going to be any growth. It's just going to be constant, right? So if you now go to your table, you look at we're looking at year 7 there, right? You put in the increase, the last increase, but after that last increase, it's just supposed to remain like that throughout, up until the future, right? There's not going to be any compounded increase like we were seeing from year 1 up until year 6. Right? And then to remain constant thereafter. So it means the amount that we are going to put on year 7, it is the last increase, and then after that increase, there's not going to be any other increase. It's just going to remain constant thereafter. All right? So let's look at for year 7, this is what we always need to do. For year 7, you are going to apply the last increase, right? In this case, we are looking at the same amount, 5 Rand, multiplied by 1 plus 0.07, right? 1 plus 0.07 to the power 7, because remember it's for the 7th year, and we get an amount of 8.03, 8 Rand 3 cents, right? Now, because we are looking at from now up until the future, we need a formula that we need to apply there, right? We need a formula that we need to apply there. We are going to have, if you check in our calculation, we have got D7. D7, that's dividend for year 7, over interest minus growth. Over interest minus growth. Multiplied by the present value interest factor, the last factor that you use. I always emphasize on that. That the last factor that you have used on year 6 is the same factor that you use on year 7. Right? Yes, just like in the assignment. So you look at dividend for year 7, which we have already calculated, it's 8 Rand 3 cents, over interest minus growth. They normally call that amount, the amount that you're going to get there, it's normally called the terminal value. Yes, now it makes sense. Ne? It's called the terminal value. So it's dividend. In this case, we're dealing with dividends. The last time we were dealing with cash flows, bigger amounts, but here we're dealing with just a dividend. So it will be dividend for year 7 over interest minus growth. Right? So that formula alone, without putting the factor, that's the terminal value. But what I've done already is, because I know that you need to discount that terminal value, right? You need to discount it to year 0 or to now. That's why I have multiplied it by the factor there, right? I know in the assignment what I've done is I separated them. I just calculated the terminal value on its own. And then in the next row, I had to take the terminal value and discount it. So what I've done here, I'm killing 2 birds with 1 stone. I'm calculating the terminal value, and at the same time, I'm discounting it. Using the present value factor, 12% year 6. Always, I know there's a temptation to use year 7. Right? Don't use year 7 in this case. Always use year 6, the last factor that you have just applied on year 6. A question from Jabulile. Yes. So if you that's a fair question. So if you go back to question 2, it's saying ExxonMobil expects its earnings and dividends to increase by 7% per year over the next 6 years, and then to remain constant thereafter. So what you always need to put in mind is that when we're saying year 7, it's not like how can I put it? We are looking at a year 7 in like as a separate year. We are looking at just after year 6 up until eternity. So what we need to do now is to effect the last growth just after year 6. And then after that, we're not going to be doing like the other growth that we were doing on the other years. So you always need to remember that after the last year that you are given, in this case, it's year 6, effect the last growth. In this case, it's that's why we call it year 7. It's year 7 it's a virtual year. Yeah, but our last end in terms of years is actually year 6. So we are now looking at year 7 into perpetuity. You put in the last growth, of which in this case we are looking at 5 multiplied by 1 plus 0.07 to the power 7, and we get that amount. Why are we putting it? Because we want to calculate our terminal value, right? So when you go to the calculation, the amounts are already given, right? We're now going to say 8.03 over our interest. Remember, it's 0.12. Our interest is 0.12 minus the growth. The growth is 0.07. The growth is 0.07. We multiplied by the factor 0.507 because we are discounting it at the same time, and then we are able to get 81 Rand 42 cents. 81 rand 42 cents. And then we add everything from the top, all those present values, right? The separate amounts that we calculated from year 1 up until year 6. We also add the big present value from the terminal value. We add them together, and then we get value of a share of ExxonMobil. In this case, is going to be 107.06. So that's the addition of everything from year 1 up until the last one, which is 81.42. All right, 81.42. All right, any further questions? So remember, this one was just on the sideline, right? We'll make time to focus more on valuation of stocks and valuation of bonds, but just because it was part of our paper, we just needed to deal with it. But remember, our main focus is mostly on capital budgeting. All right. Can we move on to question 3? Can we move on to question 3? Question 3. Question 3 is also it also has to do with capital budgeting, right? We are told that T-Systems is evaluating the purchase of a new computer system, ICX, for 130,000. The system will require additional 30,000 for installation. Right, so for us to set it up and install it, it's going to require 30,000 for installation. If the new computer is purchased, it will replace an old system that has been fully depreciated. The new system will be depreciated over a period of 10 years using straight line depreciation. If the ICX is purchased, the old system will be sold for 20,000. The ICX system, which has a useful life of 10 years, is expected to increase revenues by 32,000 per year over its useful life. Operating costs are expected to decrease by 2,000 per year over the life of the system. The company is taxed at a 40% marginal tax. All right, so we are given all this information, and we need to be able to answer 3.1 and 3.2. So 3.1, let's quickly just check what it requires. Determine the net investment. Determine the net investment required to acquire the ICX system and replace the old system, right? So determine the net investment. So in other words, they're asking us to calculate the initial capital outlay, that one on year 0. How much are we going to invest at the end of the day, given all this information that that we have? So determine the net investment required to acquire the ICX system and replace the old system. All right, it's only 5 marks, and this should be quite easy. It's a matter of knowing which amounts to add and which amounts to subtract. So first and foremost, if you look at my answer there for 3.1, I have the item and the amount, right? So obviously the first thing that you need to consider is the cost, right? The cost of the new system that they want to bring in. We are told that it's going to cost 130,000. All right, it's going to cost 130,000 rands. Now, we're also told that the system will require additional installation for additional 30,000 for installation. That additional amount for installation needs to be added to the initial cost, right? You always need to remember that installation costs, they are normally called capital costs. They are always added to the original amount, in this case of 130,000. It's more like when you buy, let's say, like a television, right? So it costs maybe so much, but you'd find that you're going to have to pay maybe extra money for its installation, to install the TV and other systems and all that. So the installation costs, they are added to the cost of the whole asset, like in this case, if it's a television. So it's the same thing with in this case, this system. They're going to buy it, and then after buying it, it needs to be installed. So the installation costs, they are part of the capital costs. So we need to add them. That's why I've indicated there, add installation. right? Of how much? 30,000.
So you said installation costs are also called what?
Capital. They are capital costs. Or we say the cost, the installation cost, they are capitalized. Capitalized in the sense of we are supposed to add them to the initial cost. In this case of we are looking at 130,000. All right. So after adding installation cost, we need to look at the next amount. You need to subtract the price, the selling price of the old system, because they have told us in the question, right? If you go to the question, they have told us that if the new where is the line? Yes, they are telling us that if the ICX is purchased, right in the middle, the old system will be sold for 20,000. Right. So remember, we are going to replace. So if it is sold for 20,000, that 20,000, it's sort of part of, it's an income, and we are going to use it as part of our, to actually add on to reduce the burden of the cost. Right. So that's why I'm saying here, I put it there as less selling price of old system. So we are basically getting, remember, we are going to spend 130, and then we're also going to spend 30. So now our costs, we are going to get 20,000. So that 20,000 is going to reduce our burden of the cost. So you need to less selling price of old system, in this case, is 20,000. So after that, having looked at everything that I have here, our net investment required to purchase the ICX system and replace the old system will now become 140,000. So altogether, let's say there was no selling of the old system, we're going to have to spend 160,000. Right? But now we are getting 20,000 from elsewhere, so we're just going to have to spend 140. Yeah, so that's where we always need to be careful about that. Whenever you see installation cost, you always need to add them to the initial cost. And when you see, like in this case, where they are going to be selling the old machine or the old system and all that, that revenue needs to be subtracted from the initial cost, so that your burden of cost is actually reduced. Right? So our net investment required to purchase the ICX system and replace the old system is 140,000. Any questions? Yes.
I just want to check. So when they're asking for about net investment,
Yes.
you always have to take the income out of the cost to know what it's going to cost the company.
Yes. Yeah. They are actually. These are actually called, it's relevant cost and relevant income. Okay. Yeah, relevant cost and relevant income. They affect your decision, right? And this, like you'd find that this 20,000, it's as if it had nothing to do with the purchase of the new system. But remember, the moment you're going to install the new system, you're going to sell this one. So when you get a revenue of 20,000, are you just going to put it aside? You can't put it aside. You're basically going to use it to actually help you buy the new system. So they are called relevant cost and relevant income, in the sense that they are going to affect your decision making.
And
yes.
Then also under items, like if this had to be, for example, a different question but asking the exact same thing.
Yes.
Net investment. What are the other possibilities that could be included in the like you see, we know, like now we see a question like this, you look for installation, you look for the selling price.
Okay.
But what else could be there that we should be on the lookout for?
Okay. For the guys that are joining us online, Lebu is asking, what other relevant items can we find on the items column, right? So this is basically what you would normally find, right? But now, let me go to the part of, like, let's say installation. Sometimes they will tell you that besides installation, they might tell you about, what do they call them? Delivery costs. Yes, they might tell you about delivery costs to say, for the system to be installed, it needs to be delivered, and these are this is the expenditure that was spent on delivering the system, and so delivery costs are supposed to be added. They are supposed to be capitalized. Another thing that they can talk about here is like on the selling of the, like in this case, they're saying selling price of old system. Sometimes they might not necessarily give you an amount per se. They can tell you that after you sold the machine, maybe you got a profit of so much. So they only tell you about the profit, right? So now if they have told you about the profit, it means you sort of need to calculate the selling price on your own, right? But it goes back to the idea of you understanding. Remember, for you to get a profit, there has to be the what is it, cost. It's like you're saying selling price minus cost is equals to profit. But you also need to know that in this case, we're talking about a system that was depreciated, right? So what you need to look at is in a situation where, like, for an example, it was fully depreciated. So you basically need to take the cost amount minus the depreciation, right? And then you also look at if they are going to make a profit of so much, you're looking at the selling price minus the cost, which is the net cost, and then you just subtract the two. So sometimes they might play with your mind just for you to calculate the selling price, the amount that you were given, because there is a temptation. Like if you are told that when the old system is sold, there's a profit of 20,000, and then you just take the 20,000, you put it there. Yeah, but what you basically need is not the profit. What you need is the selling price, and that's what you need to put on the items. Yeah. So at the end of the day, there's not much that will change, but sometimes they might play with your mind in terms of the selling price, not giving you the exact amount, but just telling you that there's a profit that was obtained and all that. And then another item is the delivery cost, which also need to be added to the initial cost. All right.
Would they ever maybe even put in there, like, the labor costs for the installation? Like, let's say they say installation is 30,000.
Yes.
And that was just maybe for the actual installation, but maybe they say costs or overtime. Would they ever put something like that in there as well?
They won't really put anything like that, unless if they tell you that normally with installation, they will normally tell you that if it's labor costs that are related to installation, they will always attach installation to that. So it won't come in, like in different angles. It's always going to be like that. Installation costs are like this, or labor costs related to installation are so much. Yes. All right. 3.2. Calculate the annual net cash flows associated with the purchase of the ICX. So here we are done with the initial capital outlay or the initial investment. We are working on the annual net cash flows associated with the purchase of the ICX. So if you go back to your question, just after the part where they tell us about the old system being sold, it's telling us the ICX system, which has a useful life, right? This new system that we are bringing in, it has a useful life of how many years? 10 years. It is expected to increase revenues by 32,000. So that's the effect that this is going to have. Revenues are expected to increase by 32,000 per year, right? And then my battery. Okay. Can I just quickly? All right, so revenues are expected to increase by 32,000 per year over its useful life. Operating costs are expected to decrease by 2,000. So you see the effect that the new system has. Revenues will increase by 32,000, and then costs are expected to decrease by 2,000 per year over the life of the system, and then the company is taxed at 40% marginal tax. So if you, with this information now, this is what you also now need to put into consideration, because remember the ICX has got a useful life of 10 years. So you're looking at year 0 where the initial investment is going to take place, ne? And then you're going to look at years 1 up until year 10 in terms of the cash flows. How much are you going to be, what relevant cash flows are going to be brought in? So let me start with the first one. Year 0, initial investment. This is what we've just calculated in 3.1. Remember we said initial investment is 140,000. I'm putting it in bracket to indicate that it's a negative amount. All right. And then we have increase in revenue. An increase in revenue of how much? 32,000. So you just need to indicate the increase in revenue 32,000 because the revenue is going to go up. Right? And then we've got reduction in operating costs. Reduction in operating costs, and we are told that costs are going to reduce by 2,000. So that effect, the effect that the increase in revenue and the effect that the reduction in operating costs is going to have is basically the same. Revenue is going to increase and costs are going to, yeah, so if you are going to be looking at the net effect will be the same. I can give you an example now. Maybe you can write on your small piece of paper. Let's say originally, maybe before this system was introduced, let's say we used to have how much? 100,000 in terms of revenues. Ne? So just write 100,000 somewhere. In terms of revenue? Yes, in terms of you write revenue 100,000 originally without this system. Let's say we used to get a revenue of 100,000, right? And then in terms of our operating cost 2,000. Operating cost 2,000. Sorry, can I make a mistake? Can I make a correction on that? Operation cost is 50,000 rather. Operation cost 50,000. So revenue originally it's 100,000 and cost is 50,000. So subtract the two and see what answer you get. 50,000. So that's the net, let's call it the net profit or the net cash flow, right? We've got a revenue of 100,000 originally without this system, right? 100,000 and the costs are amounting to 50,000, right? And our net cash flow in that case will be how much? 50,000, because we are saying 100 minus 50. Let's now put an effect of this machine. This machine is now brought in. So from the original 100,000 revenue you used to get, you're going to add how much? 32,000. So it's no longer, your revenue is no longer going to be 100,000. Your revenue is now going to be 132,000. Ne? And then change your operating costs. Remember they used to be 50,000. They used to be 50,000. So they're saying there's a reduction of operating costs by 2,000. So you say 50 minus 2,000, which will give us 48. Yeah. So it's now going to be 132,000 minus 48,000. What net cash flow do you get? What net amount in terms of profit do you get? 132,000 minus 48,000. What do you get? Come again? 34. 84. You get 84, right? So you compare the original, remember the original amount was 50,000. That's the net profit that you used to get. Now you are getting a net profit of 84. Now when you subtract the two, 84 minus 50, 84 minus 50, what do you get? 34,000. Right? So what I'm just trying to let you know is that the effect, so that is the increase in terms of the net cash. So altogether is going to be 34,000. But where are we getting this 34,000? We are getting it from what I've just highlighted on the board. Increase in revenue of 32,000 plus reduction in operating costs of 2,000. And if you add them together, they will give you 34, which is the same amount that you've just obtained now. Come again. Okay. Okay. What we're calculating, remember, it's the net cash flows or the net operating profit, because remember we are comparing revenue and costs. So most of the time, when students, especially they see that part on reduction in operating costs, what they normally do, they subtract that 2,000 because they think it's a cost item. Yes. Yes, they normally subtract the 2,000 because they think it's a cost item. But you're not supposed to subtract it. You're supposed to add it, because the net effect that it has, especially on the net amount or on the net profit, is that it's actually going to increase. Because remember, that 2,000 is basically a reduction. That's why I gave you that example to say originally, if we were looking at an original revenue of 100,000 and original operating cost of 50,000, we would get a net profit of 50,000, right? But if we increase our revenues by 32,000 and we reduce our cost by 2,000, so it means our revenue will now be 132,000 and our new operating cost will now be 48,000. Our new operating cost, because remember we are saying 50,000 minus 2,000. Yes. So our new operating cost altogether, using the example that I've just given you, will now be 132,000 minus 48,000. $132,000 minus 48,000. It's the new operating cost. Remember, it's the costs that are now reduced by 2,000.
Because you say 50,000.
Yes. Yeah. Yeah.
The thing is, it's like so easy to get it now, but in reality, it's not like we're gonna start studying for the exam.
Yes.
You see, exactly. It's like, so it's like you must write as much as you can.
This example is good because,
Yes.
Yeah. So don't just take the 2,000 in this case and you think it's a cost and you subtract it. No, don't subtract it. Before you subtract, always go to that example, right? Apply it and you'll see the effect that it will have on the net cash flows or on the operating cost. So instead of subtracting, actually you need to add, because it was a reduction in cost. All right. So first and foremost, can I go back to the increase in revenue? We've got an increase in revenue of 32,000, reduction in operating costs of 2,000. I'm not subtracting it, I'm actually adding it. That's why I do not put it in brackets. And then we have a marginal tax. We have a marginal tax. So on this marginal tax, we just need to take the net amount that we have so far of 34,000. Remember, that's the net increase that we are having. So you take that net increase of 34,000, you multiply by the 40%, because we were told that the marginal tax was 40%, is 40% from the question. So we are actually applying tax on the income, the net income that we got of 34,000. The net income of 34,000. You apply the 40%. So remember, tax is an expense. Tax is a cost. That's why the amount that I have there, I actually put it in brackets. All right. So after that, After that, can I move on to the part of depreciation? Yeah, don't worry. You always go and refer back, ne? You always go and refer back. So after we are done with the marginal tax, we need to look at depreciation. So remember, this asset is going to be depreciated for the next 10 years. It's going to be depreciated for the next 10 years. And what we are looking at here, remember, these are cash flows. Cash flows, cash flows, cash flows. And now, when you look at depreciation is considered as a cost, right? If you look at your income statement, we subtract depreciation, isn't it? But now, depreciation is not a tangible cost. As much as you have put it on your income statements, but it's not something that you can say, I'm taking out, like in this case, I've calculated depreciation of 16,000. You cannot say, I'm taking out 16,000 from the pocket and I'm paying for depreciation. You get it? So it's a virtual cost. It's not a tangible cost, right? It's just used to depreciate the cost of the system, but it's not a tangible cost. That's why we always need to add it back, especially when it comes to calculating our cash flows. So you need to add back depreciation. Why? Because it's not a tangible cost item. So if you just leave it like that, it's as if you are saying we lost some money, we lost some cash flows towards depreciation, of which that's not the case. Let's ask questions. Yeah, process it. Yeah, process it.
With this one, the biggest thing that's going to actually confuse us or trap us is going to be when to add and when to subtract.
Yes.
Everything that we've known as
Oh, yeah.
expenses, you used to subtract.
Yeah. So the reason why, you know why I'm adding it back? It is because it's going to it affects the revenue and the cost part. Because remember, you have your revenue and then you have your costs. So as part of those costs, depreciation was part of that.
So you're putting it back.
Yes. So now because depreciation was part of that, we are saying we need to add it back. Yes. Yeah. Let me give you an example with your car, Jabulile. You have your car with you, ne? And then you buy it at a certain price. Let's just to make things simpler, let's put it at 350,000. You buy your car at 350,000. Now it's possible that you can go to your bank, take 350. That's real cash, ne? Take 350,000. You give it to the seller. So that's a cash flow. It's a cash outflow. That was tangible cash that you could give to someone. How much did you spend? 350,000. Now they tell you that once you get your car, the moment you move out of the garage, it has already started depreciating. In this case, let's say it is depreciated by 20%, or let's say 10% to make it easy. 10%. 10% of 350,000 is what? 35,000. So they are telling you that your car is already depreciated in value and it has depreciated at 35,000. So that's a cost, isn't it? Yeah. It's regarded as a cost. But did you really see 35,000 cash flow going out somewhere? You get it? You are just told that it is the value of the car has depreciated. So when it comes to your income statement, you're going to take that 35,000 as a cost item, but intangible, how can I put it? It's not money that is tangible, right? So if it's money that is not tangible, when it comes to dealing with cash flows, you are not even supposed to regard it. That's what we are saying. Okay. So it's like you are told that within your costs there is 35,000, but in terms of cash flows you can't see it. So anything that you cannot see in terms of cash flows, it's supposed to be disregarded. So that's what we are doing here. It's like we are negating the effect of depreciation. Yeah. And how do you negate the effect of depreciation? It was subtracted first, so you add it back.
So yeah, so basically when it's a question of net cash flows and stuff like that,
Yeah,
when we think we must subtract, we must actually just add.
you must add. You must, especially you also need to know what you're doing as well. That's why I'm taking time to explain. So why are we adding back depreciation? We're adding back depreciation because it's not a tangible cost, right? It's actually a virtual cost. It's regarded when we're looking at our costs, but it's not really a tangible. Exactly. So you're supposed to add it back because it's not really a net cash outflow. Yeah. So you're supposed to add it. Yeah, you're supposed to add it back. So yes.
If it would have been, if it was like, I can't even think of an example that would be a virtual income, where it would have been, if it was a virtual income, so we know if it's income,
Yes, I can give you an example of a virtual income. They will say a profit on a sale of of a motor vehicle, like that was depreciated. The profit on sale of that. Yeah, it's also a virtual income. It's not really something that is tangible. What is tangible is the amount that you get. Like that, the previous case where the system was sold for 20,000. Yes, you can actually hold that 20,000. It's going to affect our cash flows, but the profit you will get, right, for the selling of that, it's not. It's a virtual amount. Yeah. Don't worry. We're still going to look at other questions. And
I hope like the questions are roughly the same in all the questions.
yes.
That we know, okay, annual net cash flow. Okay,
Yeah. So at least you need to understand the principle behind and then edit. But in this case, you also need to know what is your formula for calculating depreciation. So in this case, it's going to be cost price over useful life. Cost price over useful life. Cost price over useful life. So our cost price, remember the cost price is 160, right? 160,000. Remember, it's the 130 installation, 130 cost price plus the installation costs of 30,000. Let me show you here. 130 plus 30. We're no longer going to consider the selling of the system. We're just going to look at the amount that we would spend on getting the new system. So it's going to be 160. So that 160 divided by 10 years, and we'll get 16,000. And we will get 16,000. So we add back that 16,000. And then we just, everything that is not in brackets, we add. Everything that is in brackets, we subtract. And then we'll end up getting 36,400. So those are our annual net cash flows. You also need to indicate for year 0. And then also indicate for years 1 to 10. Yes. All right. So we are done with 3.2.
I think we probably might have to add more to the table, just in terms of like the calculations. You see, like let's say, how you got your 160,000.
Yes.
We must know that it's the 130
Plus the 30,000. Yeah. And another thing, you'd find that, you see, the first time you look at something, it looks complicated. But I tell you, go and watch this video again and watch it 3 times. This will become like your, everything will be like on your fingertips. Yeah. Just go do it again. Second time, don't stop there. Go do it the 3rd time. When you do it the 3rd time, you will be up and running. Yeah. Yeah. Let's look at question 4. Question 4. Consider the following. Yeah. Consider the following information for two mutually exclusive projects undertaken by Lovers Food Market. So these are two mutually exclusive. The moment you just see that, two mutually exclusive projects, it means we cannot accept both projects at the same time. We are going to accept one and drop the other. That's what it means. So they cannot be undertaken at the same time. They cannot be undertaken at the same time unless if they are independent, because sometimes they'll say two independent projects. So if they are independent, it's possible that both of them can be accepted. But if they are mutually exclusive, it means one has to be taken, one has to be dropped. All right. Consider the following information for the two mutually exclusive projects undertaken by Lovers Food Market. So we've got that table there. So we've got project A and project B. We have the year 0 up until year 5. And then we've got the annual cash flows, estimated annual cash flows. So what do you see there, especially for A? The amounts are the same. It's 10,000, 10,000, 10,000, 10,000, 10,000. And we're going to consider that as an annuity. For B, it's the same. I'm sure when you look at a question like that, already you know you are pocketing your marks.
That's why I'm saying if I don't get this 100% question,
Yeah,
this question particularly, then I'm going to
you go after it. Like, all right.
You wish like these are the ones who like the majority of the
So
90% of them.
yeah, so we are told that Lovers requires a 14% rate of return on projects of this nature. So we are using rate of return of 14%. All right, so you quickly, let's look at 4.1. Calculate the NPV of both projects. Right? This is now becoming a chorus now. Right? Because it's one and the same thing. All right? So my tables, same format, year column, annual cash flows, calculation, and then I have PV or present value at 14%.
Now, for this one, I'm using table 5, right? Table 4, sorry. Yes, that's what I wanted to say was, now with this one, I use table 4.
Yes, you use table 4.
To my 14%.
Yes.
And go to year 5. Well, 1 first, and then I'll go to 5 because it's the same. Then I just use the year 5 factor.
Yes. You use year 5 factor. So let's analyze project A, right? So because it's the same amount, our table is not necessarily going to be that long, right? Everything can just be minimized like that. So we have year 0, and we've got minus 30,000 because we're told that there's an initial investment of 30,000. Eh? And then in our calculation, we are going to, you need to be careful on this one because it's an initial capital outlay of 30,000 and it's a single amount. It's not the same as those 10,000, 10,000, 10,000, 10,000. So now when you apply the factor, well, you don't necessarily need to go to a table, right? There's no need for that because a factor for year 0 is always going to be 1. A factor for year 0 is going to be 1. On the calculation, we're just doing it just for the sake of showing that we know what we are doing. Right, that you are a smart student, right? But the factor is always going to be 1 because it's like you're saying, what is the value? What is the value of 30,000 that you have invested now? What is its value now? So it doesn't need to be really discounted. It's just 1. You multiply it by 1, and it will be the same value. All right. So you put the value, the present value factor 14%, and then you put year 0. Right, and then it's going to be 1. So it will be minus 30,000 multiplied by 1, and then it will give you minus 30,000. Right, and then from year 1 to year 5, the amount is the same, is 10,000. So you don't necessarily need to separate the years. Right, you just say year 1 to year 5, and then you take the amount is 10,000, and then on your calculation you're just going to put 10,000 multiplied by the present value interest factor annuity, which is table 4. Right? So you go to the column that has got 14% and 5 years. Remember to take 5 years as your on your row, right? You select row, which has got 5 years, and then you apply the factor. The factor you will see there is 3.433. A question from Tsepiso.
So let's say I've got enough time.
Yes.
Is it wrong for me to say here 1, 2, 3, 4, 5 and put my factors and calculate?
Yeah.
Is it wrong?
It's not wrong. It's not wrong. Let's say you have all the time in the world.
That's why I said time.
Yes.
Remember, time is of essence. That's why we are using that method. But I want personally to say, okay, so that I don't get confused. 1, 2, 3, 4, 5. It's still okay for me to do that.
It's still fine. You can still use table 2, but it means you need to separate your factors. So you'll be saying year 1, 10,000 multiplied by the present value interest factor, 14% year 1. Then you go to year 2, table 2. Yeah, if you are going to separate them, then you need to use table 2. Yes. Yes.
With a question like this, with regards to what Tsepiso was asking, isn't it like, mustn't we also maybe then also use the mark allocation as like an indicator? Let's say if this is all it was asking, calculate the NPV for both projects, right? But that's all that they wanted. But let's say the marks were like for 10 marks. Right. Would it be then better than to actually then separate it? Because in that case, we wouldn't necessarily know where all the marks lie.
Okay, Lebu is asking, let's say the mark allocation was, let's say, more, and then you asked a question like this where the years are, like in this case, 5 years. Do you need to separate the amounts, 10,000, and then you put a present value factor for each year? There's no such a thing. There's no such a thing. Let me tell you something. In the exam, you're going to be given how many hours? Is this paper 3 hours? Let's be practical about it, right? You are not going to find extra time. You are not going to have that time to say, I have extra time, let me just separate the amounts. You're not going to have that. You realize that in the exam, an extra minute will be like gold to you, right?
Also, they'll never ask a question like, a simple question like this will actually never be for like.
Yes, you just need to know that if you have got an annuity, the same amount throughout the years, if you've got the same amount, apply it like that. It's going to help you, especially when it comes to saving your time, right? I don't want to advise you to say, okay, alternatively, you could separate them. You might get the right answer, but the question is, why are you wasting your time, when you could apply it like that? So even if the mark allocation is saying 10 marks, you're going to get all your 10 marks from there. Because it's a matter of, do you know what you are doing, right?
I was about to say that's what then, to me, that makes more sense. That
Yes.
regardless of the marks, as long as you're doing the right.
Yeah, exactly. So this is the right way. You know that you're going to be using table 4, right? Yeah, as long as you use the right table, you compress everything and then you get your answers like that, right? So yes, the other person is still going to be getting the same marks. They are not going to get extra marks because they've separated the tables. They are basically going to get the same marks as these ones. All right. So you need all the time in the exam, right? And yeah. All right. So from year 1 to year 5, we use the present value factor annuity, 14% year 5, and it's going to be 3.433, right? You multiply it by 10,000 because it's the same amount, and then you get 34,330. So that 34,330 you now subtract, because remember you want to find the NPV, right? Now another thing you could do, which I might add a little bit later on the slides that I'm going to upload. You see, it says here the NPV, right? And in the calculation column, you can indicate 34,330 minus 30,000, just to show the marker that you know where you are getting your NPV, right? So it will be 34,330 minus 30,000, and you will get 4,330 as your net present value. All right. So easy, ne? Yeah. So those are 4 marks in the pocket. 4 marks in the pocket. All right. Project B. All right. We've got a question from Madre. What if the PV is 14.5%? What if the PV is 14.5% and it's not on the table, right? What if the PV is 14.5% and it's not on the table? We dealt with a question like that, ne? Thanks, Madre. Thanks for the question. Yeah. So when you find when they're asking me to repeat the question, what if the PV is 14.5% and it's not on the table? Isn't it we are using the factors on the table in the textbook? So sometimes we find that the factor is 14.5, and on your tables, after 13, it goes to 14, and after 14, it goes to 15, right? So in such a case, you do not have much of a choice, because remember, it's a race against time, right? You are chasing time. You don't necessarily need to, in this case, you're going to have to use your calculator.
It's the same as the one question in the second assignment.
Yes. Yes. So you're going to have to use your calculator in this case. You do not have much of a choice, right? Another method, alternatively, is to do it manually by applying the formula, right? You do it manually by applying the formula, which I will also put. I actually forgot to put it on the slide, right? I'll put the formula up. Apparently, when I upload them, Madre, I'll also put the formula there. So with the formula, it's going to take you time, because you now need to take that, you replace it with that and that and that, and you are in the exam. You are chasing. It's a race against time. So you do not have much of a choice, but you're going to have to use your calculator. So in this case, when you are using your calculator, right, you're going to have to punch. You clear your memory first, right? You clear your memory first, and then you put 10,000 as your PMT, right? You put 10,000 as your PMT, because remember, it's an annuity. It's the same amount throughout. So 10,000 as a PMT, and then 14. In this case, we are using 14.5. 14.5. That becomes your percentage for interest rate, or for I, that small I. Yes. So your I is 14.5%. Your N is 5 years. Your N is 5 years. That's the number of years. Your N is 5 years. Is there anything that we have left out? I think we have put in everything. Then you compute PV. Compute PV. Compute PV. 33 point. Yes, you got 33,900 and something. Right. Now we call that an error, a margin of error. It's caused by the decimal places. Right? It's caused by the decimal places. So if you use your calculator, you get a slightly different answer from the one that you have from here. Because here, remember, we are using factors. And in other words, remember, we're also using 14% here. It's not in our calculator. We're using 14.5%. You get the idea? Come again.
What will then this 33,922 mean to me? Would it be that instead of the 34,330,
Yes.
it'll be your 30?
That will be your present value for that annuity.
Then you say minus 30.
Yes. So that will be your present value for that annuity.
Because I agree the 34,000 is worth 14%.
Yes. So if it's 14.5%, use your calculator, because remember, you want to gain marks. But now if you are using your calculator, you're not on that column of calculation, you're not going to be able to put 10,000 multiplied by the factor. You can skip that part. Right? But compute, like to say you put your 10,000 as PMT, so you write 10,000 PMT, I 14.5%, N 5 years, and then you compute PV, and then you get your value. Yes. Come again. Yes. Yes. If you are going to do it in a form, just like I said, I'm still going to send you the formula, but that is the formula that says 1 over 1 minus that to the power that, in, you know. So in the exam, to be honest, I would discourage you from using that because you do not have time to go through, you know. You've got your calculator with you. Yes. You've got your calculator with you, quickly use it, right? If you've got a factor, like in this case, it's 14%, you know that that factor is there in the textbook, go to the textbook. And then you're able to finish your exam in time.
With these questions, where they give us the discount rate, they will never ever give us 14 point something. It'll always be a round number.
To be honest, 99% of the time, they're always going to give you a whole number, like in this case, 14%, 13%, and all that.
Chances are, because if we had to, for some reason, work it out,
Yes.
that we'll probably get the decimals. Hey, if it was a question where we had to work out at what rate,
That's
and
true.
we were to get the decimals, and then the follow-up question, you have to incorporate your discount rate. That's where we'll probably get the decimals. Hey, but
That's
if
true.
it's given to us, it's always going to be around.
It's always going to be like that, yeah.
You say 99.999.
99.9999%. All right. So, okay, we are done for project A. Project B is basically the same concept. You just need to know your initial capital outlay. You know, year 1 to year 5, it was the same amount, 20,000, and then you calculate your present value, and then you got a net NPV of 8,660. So remember, 4.1 was saying calculate the NPV of both projects for 4 marks. So you just do that. Imagine in this case for 4 marks and you need to separate, that's going to take your time. And the marks are also not worth it, right? And then 4.2, calculate the profitability index of both projects. Calculate the profitability index of both projects. Project A, we've got project B, and we also need information on the initial investment and information on the net present value. Why? Because our formula is going to need that information, right? So quickly, maybe before we look at that, just look at the formula for the profitability index. I've put it in the last column there. So the formula for the profitability index is 1 plus NPV over initial investment. That's the formula. And you've got those amounts. You don't need to, you know, dig them from elsewhere. Yes, another 4 marks. So you just need your NPV and you just need your initial investment, and then you are good to go. So now, in your table, you're just going to indicate that this is project A, this is project B. This is my initial investment for A, this is my initial investment for B. My NPV for A, NPV for B, and then you just put that into your formula, right? Come again? It's still fine. Yeah, it's still fine because it's just a matter of how many decimal places you're going to put. So if you put that 1 plus 4330 over 30,000, the first one will give you 1.144, and then the second one will still give you the same answer. Right? Just try it out and see if you get the same answers in your calculator. It will still give you the same answer. So in this case, our profitability index is the same for both projects. So normally, if they are different, after you've calculated the profitability index, you need to rank your projects based on the profitability index. Come again? No, okay, with NPV you still how can I put it? It's when I talk of ranking, it's the same concept that I'm going to apply on the net PV, because okay, let's go back to NPV. With NPV, you are going to take the project that has got a higher NPV. And then with profitability index, you're also going to take the project that has got a higher profitability index. Yeah, that's what I mean by ranking. Yeah. So if you noted, if you look at the profitability indices that we have here, they are the same. So there's no one project that you're really going to select over the other based on the profitability index. But our NPV is different. Yeah, so you take the one that has got a higher NPV.
Will they, when they ask you, let's say, to rank,
Come again?
when they ask you to rank the projects, right? Will they actually say maybe they based on NPV or based on profitability index? Or if they just say rank these two projects, would we then have to then maybe see, okay, this one has a higher NPV and this one has, and this same one has a higher profitability index? Or are they always specific?
Okay, Lebu is asking, when they ask you to rank the project or or when they ask you which project to accept or to select, are they going to be specific to say, in this case, according to the PI or according to NPV? How do you go about doing it? Now, look at the question. What is it that the question wants you to do? Right? So far, if you look at this, right, it's saying calculate the profitability index of both projects. So we're not really going to rank and say we are going to accept this and not. We're just calculating it and then we leave it at that. So if you then, for example, if you go ahead and say, because of this, we're not going to select this, you are now just going out of the out of the bounds. All right, but let me come to your question, noted Tsepiso. They will ask you always, most of the time, not always, most of the time, they will say, like I think we already have that situation on, yes, 4.4. Which of the two projects, if either, should lovers accept and why? So it did not specify that is it according to NPV or is it according to profitability, but we know that we've already calculated that. So that's what we are going to be using as our frame of reference, because we already have calculations based on the NPV and the PI, the profitability index. So I'll get to your answer maybe when you come to 4.4. Tsepiso, you had a question?
I'm going to be covered under 4.4.
Okay, it's fine. So our profitability index, you just need to know the formula, apply the formula, leave it like that. How many marks? 4 marks.
And I got it.
Yes, and you got it already. Yeah, all right. So let's look at 4.3. Calculate the payback period on both projects. Calculate the payback period on both projects. So we're going to look at project A and project B, right? So the payback period is one of the easiest, one of the very easy, things to do, right? We're looking at initial investment. Let's look at project A. It's 30,000. So that's what you start with. So remember the concept or the principle behind payback period. We are basically saying you have invested 30,000, like in this case for project A. How long is it going to take you to recoup that money, to get that 30,000, the initial investment? How long is it going to take you? How long is it going to take you to get your 30,000 back? Ne? So now what we need to do is to start with the initial investment itself. We start with the initial investment itself is 30,000 and we subtract. That's why I said there, less year one cash flow. It's 10,000, right? So I subtract 30,000 minus 10,000 and I get 20,000. All right? So I'm just showing that just to show my stages. But in other words, sometimes you could just say less year one, year two, and year three, knowing that, okay, I'm actually still within the region, right? I'm not going beyond. So what I've done there, I've subtracted 10,000 from 30,000 and it's 20,000. That's what I'm left with. And I subtract or less year two cash flow, another 10,000, and I'm left with 10,000. And then I subtract or less year three cash flow, 10,000, and then I'm left with 0. The moment I know that I'm left with 0, I know that I've recouped my 30,000 initial investment. So in this case, it's going to take me how many years? 3 years to pay back the initial investment of 30,000. So I'll just write it payback period 3 years.
So payback period, it must always be, you need to always get to a zero.
Yes.
You always have to get to a zero.
You always need to come to
Minus.
yes. As you subtract, you always need to count. The moment it says 0, then you know, oh, I have recouped all my. It's an indication that you have recouped all your money that you have invested. It's an indication that you have recouped all the money that you have invested.
So if the cash flows for each year were like different values, that's what we'll be subtracting that, obviously.
That's true. That's true. But I want to introduce a complication. Right? It's not a it's not a much of a complication, but it's something that you can deal with. Now, if your cash flows are, these ones are neat, right? Everything is neat, everything is straightforward. And 70% of the time, it's always going to be sort of like this. They will be neat and straightforward. Your years are always going to be like whole numbers. But sometimes you'll get a situation where they will say, it's 30,000, and then they'll say, cash flow, let's say cash flow for year 1 was 15,000. Right? Cash flow for year 1 was 15,000. So you're going to say 30,000 minus 15,000, and you'll be left with 15,000. Ne?
What happens when the payback period is a negative?
Yes. All right. So we have, instead of 20,000, we have 15. And then you say minus 10,000 for year 2. So 15,000 minus 10,000, we are left with 5. Right? We are left with 5,000. So we have already, we are done with 2 years already. So we're now left with, in year 3, we have another 10,000. So what we'll do is, remember on top there we have 5,000. Our balance is 5,000. So what we will do is we subtract cash flow for year 3, which is 10,000. So it will be 5,000 minus 10,000, and you will get a negative 5,000. So that negative, it tells you that part of the amount for year 3 was not really necessary. It didn't need to be included in the calculation. We only needed, from the 10,000, we only needed to take 5,000 so that it can come to 0, just like you were saying.
So it would have been that our payback period would have recouped by year 2.
Year 2.5.
2.5.
Yes, 2.5. Yeah. So what you need to do always when you come to that, when you come to a situation like, you still subtract the whole amount, like in that case 10,000, and you'll be left with a negative 5,000. Don't worry about the negative 5,000 because your marker is not really worried about that, right? But when you see in that case of negative 5,000, what you need to do now, remember in year 3 you had 10,000, all right? And then, so on that 10,000, remember what you need to do is to take, remember the 5,000 that you had as a balance, you divide by 10,000, which is the amount for the whole year. So it'll be 5,000, which is the balance, right? 5,000, which is the balance there, divided by 10,000, which is the amount for the whole year. In this case, it's year 3. And you'll get what? 0.5. So in this case, remember you exhausted the whole of year 1. You exhausted the whole of year 2. So it will be 2.05, 2.5. Yes. We're going to, even when, I think what I'll do is, on the slides, I will also add that scenario. Yes, so that you are able to see the whole picture. Right? I'll add a slide on that so that you are able to see the whole picture, and then you are able to compare, right, which is which and all of that. Come again? Yes, the other time when we were doing, I think it was a question from here. I think I was explaining. Yeah. But I'll still put it so that you can, keep referring to that. Project B, still the same, right? So it's for both projects, the payback period is going to be 3 years. All right. So now, which of the two projects, 4.4, if either, should lovers accept and why? So we have calculated the NPV, and we have found that the NPV of the two projects, I have even indicated there, For project A, it's 4330. For project B, it's 8660. The PIs, or the profitability index for the two projects, are 1.144 for both. So when it comes to the profitability index, they are at par, right? They are actually the same. When you go to the payback periods of the two projects, they both have 3 years. I'm just looking at the information that we have calculated on the previous questions. So the results, I've indicated that the results show that the profitability index and the payback periods puts the projects in the same ranking, right? Because they are basically the same. So if let's say the profitability index of A was higher, it means you're going to select A according to the profitability index. So you always take the one that has got a higher profitability index. Then according to the payback period, the ranking, the one that has got the lesser number of years is the one that you put higher. Because obviously when you invest into something, you would want a project that will take you lesser time to recoup your money, isn't it? So the one that has got lesser years is the one that you rank higher, or the one that you would accept.
Even if the NPV was lower than the other project?
Not really. I'll come to that part. I'm just saying if you were only to use, if you're only going to be using payback period without mixing it with others, right? And then, so according to what we have calculated so far, the PIs and the payback periods, they are the same. So we're not really going to worry much about that. The only difference that we have noticed is only on the NPVs. So if the NPVs are different, it means now we are going to rank our projects based on the NPVs. Why? Because they are different. Right? So the NPVs show that project B has got a higher NPV than project A. What is my conclusion therefore? My conclusion therefore should be Lovers should accept project B because of the higher NPV and due to the fact that these are two mutually exclusive projects. One has to be selected and the other has to be dropped. One has to be selected and the other has to be dropped. So my NPVs show that project B has got a higher amount, so that's what I'm going to select based on that. Right? Now, when you do your calculations, right, your profitability index and your payback periods and all of that. Now, when let's say you are mixing them all together, let's say your NPV is saying select this, and the payback period is saying select the other. Out of all the methods of evaluation that you're going to be using, the NPV is the main one. The NPV is the main one. Right? So you always need to rank according to the NPV. The others, like your PIs, your profitability index, and your payback period, they are supportive. They are there to support the main one, which is the NPV, net present value. Even when I know we're still going to calculate the IRRs and all that, those are also still supportive. The main one is the NPV. Yes. All right. Let's quickly move to question 5. All right, we're almost there. We're doing good with our time. Question 5. Thermal Corporation is evaluating 2 projects for the replacement of its old cooling unit. The existing unit has recently stopped working and has no salvage value. Of the 2 competing units, B has a long life but a higher initial cost than the cheaper unit, which is A. The following data are available for evaluation. So we've got net cash flows for both projects, A and B. Already when you look at a question like that, those are free marks in your pocket again. Yeah. So we've got net cash flows, and then we've got the years, and then the marginal cost of capital. Remember, marginal cost of capital, rate of return, discount rate. This is basically one and the same thing. in terms of when you're going to apply the percentage that you're going to be using on your tables, you'll be using basically that percentage. So in this case, we're using a percentage of how much? 19%.
So it's marginal cost or rate of return or discount rate?
Yes.
The same thing.
Yes. 19%. All right, let's look at 5.1. What does 5.1 want us to do? If the projects cannot be repeated, which cooling unit should be purchased if thermal uses NPV as its criterion for, I think there's some letters that are missing there, as its criterion for project selection, right? As its criterion for project selection. All right, so quickly, if you go to your table, we're starting with project A. What is it that you notice in terms of the cash flows? They are the same. From year 1 to year 3. That's table 4, right? Because it's an annuity. And then, so basically, remember you want to calculate your NPVs. That's why I said those are free marks. Because it wants you to calculate your NPVs and you're just going to apply the same methods. You see? So if you were to sit on this exam paper, really, you're going to come out with a distinction here. All right. So we're calculating the NPV of cooling unit A. So it's year column, net cash flow, calculation, present value at 19%. The year 0, we know what to do there. It's 50,000 multiplied by the present value factor for year 0, which is always 1. And then you get your 50,000. From year 1 to year 3 is 25,000. Present value interest factor annuity, remember? Right? And the factor will be 2.140. Right? You multiply 2.140 by 25,000 and you get a present value of 53,500. Right? And then you have you are now calculating the NPV of cooling unit A. You see there I've actually shown the calculation, noted Mr. Gordon, right? So I've put it as 53,500 minus 50,000, which is the initial capital outlay, and I get a net present value of 3,500. Yes, Mr. Gordon. Yes, it's always 1. For year 0, the factor is always 1. For year 0, the factor is always 1. Yeah, it's more like I was giving an example. If I'm having 100 rand in my pocket, right? We're looking at year 0 as now. So I've just given you 100 rand. So I'm asking, what is the value of this 100 rand now? It's 100 rand. So that's why you always multiply by 1. Yes. So it's always 1 throughout.
So if they did not indicate year 0, we'll just start by year 1.
Come again?
If they did not have year 0,
Yes. Yes.
we'll just start straight by year 1.
By year 1, based on what you are given. Because with some questions, like you noticed with the valuation of stocks, we didn't need year 0 information for year 0. But with these ones, because we are making an investment in a project, so you always need year 0. Right? You always need to, when you actually read the question, already you should be knowing that, okay, I'm going to deal with year 0. Sometimes you'll even look at the information that you are given from the question, like in this case, already the table has given you information for year 0. So you're just going to need, information for year 0 on your answer.
If year 0 is not given, they start with year 1.
Yes.
I start with year 1.
All right. So that's your answer for cooling unit A. And then cooling unit B, it's basically the same as well because the cash flows are basically the same from year 1 to year 5. Yeah, so the method is the same. The method is the same. You apply the same for cooling unit B. So the NPV that you end up getting there is 6,624, right? So now they are saying if the projects cannot be repeated, which cooling unit should be purchased? If thermal uses NPV as its criterion for selecting projects. So you need to write your final answer in this case. You were not just calculating the NPVs, you wanted to find out which one are you going to select of the two based on the NPVs. Yeah, so if the projects cannot be repeated, thermal should purchase cooling unit B since it has a higher NPV. Amen. Your free marks. All right. 5.2. Assume that the project can be repeated and that there are no anticipated changes in the cash flows. And there are no anticipated changes in the cash flows. Using the equivalent annuity, using the equivalent annual annuity, which is the EAA, we call it the EAA method. What is the EAA and the NPV of the two projects? What is the EAA and the NPV of the two projects? Now, with this one, I'll give you another question, which would want you to tackle this in a different way, because we also have what we call the replacement method. And this one wants us to apply the EAA method. So I don't want us to talk about the replacement method today. We'll create some other time, right? So what you need to do, it's the problem with this one is most of the people, they don't know how to apply that formula, right, of EAA. So you always need to be careful when you apply the EAA formula, right? So what I need basically is, okay, first and foremost, what you need to know is the formula. So the formula, I've just put it under calculation there, right? You have your formula, and then let's look at project A. So remember, project A has 3 years and project B has 5 years. You use the EAA method for projects that have got different lives, because sometimes when you measure them, it's as if like it's unfair because the other one has got a shorter life and the other one has got a longer life, right? So in this case, when the projects have got different lives, you use the EAA method because it's sort of, how can I put it? It brings a weighted average in terms of the cash flows. Yes. So that when you now come up with the final answer of your EAA, you select based. It's like you're putting them on an equal footing, right? And then you select one based on equal terms. So in this case, that's what we need to apply. Project A for 3 years, and then the NPV is 3,500. And then for B, it's 5 years, and the NPV that we calculated earlier was 6,624. Now, you just need to apply all of that in your formula, right? So if you look at the formula, it says EAA is equals to R multiplied by NPV, right? So that is in its own bracket, divided by bracket 1 minus another bracket 1 plus R, bracket again to the power negative n. So all those figures you are given. R represents the rate of return, right? And you always need to put it, especially when you put it in the calculation like that, put it in decimal. So if it's 19%, it's going to be 0.19. If it's 19%, it's 0.19. So in this case, for project A, we are saying 0.19 multiplied by 3,500 because that was our NPV. We close the bracket, divided by another bracket 1 minus bracket 1 plus 0.19 because that's where R is again. We close the bracket to the power negative 3. Always remember to put to the power negative the number of years. And then we close our bracket. So when you punch it in your calculator, you need to be careful. Yeah, you need to be very careful. I know there's other calculators that you can program and they can, give you a nice answer straight away. But when you come to something like this, right, first and foremost, right, you need to sort of work separately with those brackets. So what I'll do is I'll look at the first bracket. It's saying 0.19 multiplied by 3.5. So I'll multiply that in my calculator. 0.19 multiplied by 3,500. Right? I put that answer down. I write it down somewhere. Ne? And then I go to the next bracket. It says 1 minus 1 plus 0.19. I don't need to worry about the first one. I'm going to leave it. I'm going to go to the second bracket, which says 1 plus 0.19. So I punch that in my calculator, 1 plus 0.19. And I get my answer, which is 1.19. And then I put that to the power. So I'm saying 1.19 to the power minus 3. Separately.
How do you do this?
Do you have negative here? Not negative, power sign. Let me see.
Because then one can use a scientific calculator in this case.
Yes. It should be there. I think I did it the other time, last time. Are you able to see it, Lebu? Yes. Let's see.
Don't worry, Arthur will do it next week.
Yes, but I did it last time and
And I want to write a note so that I don't forget.
okay. No, it's fine. Lebu, are you able to get it on yours? The power sign. Okay, it's fine. I'll quickly look at it later. Isn't it our calculators? You'd find that they are different. Yes. So you'd find with that one, I think it's fairly easy. Yes. With the sharp calculator, it's fairly easy. Yes, I found it. On the HP calculator, my thing is limiting you. So let me just, I want to say 45 to the power 6 or to the power negative 6. So 45 second function, you see here, yeah, to the power negative 6. So I put 6, where's your negative? Negative. And then I should get a weird answer like this. It's 0 point something, something, something. But I want you to punch that one and see if you are able to get the answer. But your
But you must do shift because an orange button.
yes.
When it's white, you don't have to do shift.
Yeah. Yeah. I remember we did it last time. I think it was with Naledi. Yeah.
So we say 1.19.
Yeah. To the power minus 3.
What did you get, Julie?
Yeah, it's fine. You write it down somewhere. Yeah, you write it down somewhere, 0.59. Eh? So remember, that's the answer that we want, but it's not our final answer. So now, you got 0.59. So you now say the next step is to say 1 minus 0.59. Because that's according to that formula. That's according to that formula. 1 minus 0.59. And you write that answer just on the side. And then remember, initially, the first answer that you got when you said when you punch 0.19 multiplied by 3.5, you remember where you put that answer somewhere. Yeah, make sure you don't lose your answers. Ne? So you're now saying, because you have this, right, and you now have this, you now divide the two. So this minus this divided by that, it should give you 1,635. 1,635.58. Even if you get a slightly different answer, it will still be fine because of the decimals and all that. Because of the decimals. So it's basically the same. You do the same for B. You just need to be careful on the use of your calculator because you might end up getting a wrong answer if you just punch it straight. You're getting a different answer.
What did you get? I wanted to take what's it could be up for 5, isn't it? And then minus again.
Oh, sorry.
And then equal to 0.42. Yes, that's the first one. I got 0.41. That's for the 9.
Yeah, 0.41.
Yes, then you
So that's what you get as a denominator.
Why did I get 42?
0.42. It's fine. It's not that different. 0.41 versus 0.42 is fine. Yeah. So the first answer that you got when you said when you punch 0.19 multiplied by 3.5, what did you get? 665. Divide that by 0.41.
I get 1621.
16. It's still fine because of the decimals, remember? Yes. So you'd find that your calculator, if it's put, let's say, in a 2 decimal or 3 decimal mode, it will give you a slightly different answer, but it's acceptable. Your marker is able to give you your full marks. Your marker is able to give you your full marks. All right?
So now with the annual annuity being different, the other one is higher than the other one, what can we then choose from?
Come again.
I'm saying the annual annuity are different.
Yeah.
Yes, then being different, what does it tell us?
Or what does it mean? Yeah, that's why I said you'd find the years are different. The other one has got 3 years and the other one has got 5 years. So with the annual, that's why they call it the equivalent annual annuity. We are trying to put them on the same basis, even though the years are different. So that when you choose the project, you choose it from an equal footing, right? Because remember, the years are different, so you sort of trying to bring a same balance as far as the years are concerned, right? And then in this case, the project that has got a higher EAA is the one that you select, right? So in this case, the one that has got a higher EAA is project B, right? So remember, the question only wanted us to calculate using the equivalent annual annuity method, what is the EAA and the NPV. The NPV, we have already calculated it previously, right? So you're just going to basically use the ones that were calculated already, right? But if you are using a different method, which we'll talk on, which we'll talk about the other time, the replacement method, you'd find that your NPV is not going to be the same. But don't worry about that. Just focus on this method for now. When you're asked to calculate the EAA, this is what you do. Calculate the NPVs first, and then go and apply the formula for EAA. And then the one that has got a higher EAA is the one that you select. Like in this case, project B.
So in this case, we don't consider NPV. Let's say NPV for project B
Yeah.
is lower
Yes.
than project A.
Yeah.
But the EAA for project B is higher than project A. Then we use the
The EAA. Yes. Yeah, you use the EAA.
What method we should use to evaluate.
Yes.
Okay, so the EAA is the one.
The EAA is the one. All right.
But I think just for argument's sake.
Yeah.
Just for argument's sake.
Yeah.
I think in this scenario.
Yeah.
The B has advantage of having
Over A.
Yeah, because it has a more number of years
Yes.
to A.
To A. Yes.
That's why then it yields.
That's true. But you find that the sort of the disadvantage that B might have is the fact that you're going to have to invest more.
For the extra 2 years.
Yes. So you're looking at an investment of 60,000. So sometimes you'd find that because of the more investment, even though the cash flows are going to come in more in terms of years, but it's not really going to be worth it in terms of, okay, we're going to take much time to recoup and all of that. So it's based on a number of issues, but your point is very valid. Yeah, your point is very valid. All right. So quickly, 5.3, Is it fine that maybe I'm looking at, I don't want to exhaust you more. We can finish question 5 and maybe finish question 6. And then question 5 and question 6 and then question 7 and 8 will create time on its own. Question 6 is talking about, it's also capital budgeting. Right. Yeah. So I don't want to keep, giving you information only to find that it's no longer getting in. Right. Yes. So question 5 and question 5 and question 6, is it fine? Yeah. I'm also saying this based on I could tell that some of you are tired now. Yes.
You know what the good thing is actually, it's just like how Tefiso was asking, is it about shares or whatever? You know, if it's something that it's easy for us to grasp now, it's
Yes.
okay. Instead of like having to give
Yeah.
150% concentration.
Okay. Yeah. Let's quickly finish 5 and go to 6 and then maybe assess after 6 that should we go on or should we stop there? All right. Which project should be selected and why? So project B should be selected because it has a higher EAA. We're now answering your question, Sapiso. Which one then do we select? Right. Our final answer should be based on EAA. So you're saying project B should be selected because it has a higher EAA than project B. Project A, I mean to say. Right. So we are selecting project, which project? B. All right. So that's 5.3. It only had 2 marks. All right. Question 6. Question 6. Your company is evaluating 2 independent investments with the following cash flow streams. So we've got A and B. Your company, you see, capital budgeting is all over the place. Your company uses a combination of the net present value approach and the payback approach to evaluate investment alternatives. It requires that all projects have a positive, so here the question is particular. It requires that all projects have a positive net present value when the cash flows are discounted at 10% and that all projects have a payback no longer than 3 years. So if any project has got a negative NPV, it's out already, even if it's independent projects. If any project has got a higher payback period, like of more than 3 years, it's out, according to this criteria. That's so sometimes you need to be careful about what the question is asking you. Right? So, all right, let's look at question 6. What is it asking us? Which project or projects should the company accept and why? Right. So remember, these are 2 independent projects, so it's possible that we could accept both. These are not mutually exclusive projects. So we could accept both, but we need to apply the criteria. So we go ahead and calculate our NPVs and the payback periods for 2 different projects. So if you look at what I've done here, I've also killed 2 birds with 1 stone. Right? I've calculated both the NPV and the payback period on the same table. Right? So first and foremost, let's look at the calculation of the NPV. It's basically what we were doing, on the previous questions. The amounts are different throughout the years, so I need to separate, which means I'm going to be using table 2. Right? I'm using table 2, so I get all those present. I don't think I need to repeat on those because it's basically the same. Right? It's basically the same criteria. The factor for year 2, there's a correction. Let's check the factor for year 2. Let everybody just verify. Medre, you can also verify.
0.826. Oh, but I think it's round 0.826. It could be rounded.
All right. So
because you've got 8.827.
yes.
Oh, it could be a typo.
It could be a typo. Yeah, but what you basically need to do is to go to your table, take what is there, and you just, so if there is a mistake, I think it's a slight mistake. Right, so you apply the factors there, you multiply by the values, and then you get your present values. And then your NPV, it will be the addition of 18,180, like I've shown in the calculation column, plus 16,540, plus 7,510, plus 34,15, plus 31,05, minus the initial investment of 50,000, and I'll get an NPV, or net present value, of negative 1,250. Yes, it's negative, so it's out.
Yes.
Ne? Remember our criteria? In fact, whether there was a criteria here or not, every negative NPV project is out. I've gone ahead to calculate my payback, right? So with my payback, I have done exactly what I did before. It's just that here it's now just, across instead of going down. So I've looked at my investment of 50,000, right? Initial investment is 50,000 minus year one. Year one, remember, is 20,000, right? Minus year one, 20,000. So it's 50 minus 20. I don't know why I put a 40 there. It's supposed to be 30. Yeah, please note that it's a mistake there, right? 50 minus 20, it's supposed to be 30. Right, so 30 minus 20, it will be 10, and then 10 minus 10, it gives me 0, so it will be 3 years. So I'll make sure that I correct on the part of 40,000 there. All right, and then.
But that 8.7, number 2, the factor, it would not give that much difference in terms of the.
Yes, it's not that. Yes. So it's more or less the same. All right. So it's a trivial matter, that one. You don't even need to worry about it. Yeah. All right. Let's move on to B. Same calculation on the NPV. All right. The factors are the same. I apply because it's the same percentage. And when I calculated my NPV, I had to add everything, and then I come to the NPV of a positive 18,460. So it's a positive NPV, so it means I'm going to accept the project. Payback, so I'm starting with 40,000 because that's my initial investment, minus year one, 20,000, so it's 40 minus 20, which will give me a balance of 20. So year one is out. Year two, 10,000, and it will be 20,000 minus 10,000, and I'm left with a balance of 10. Year three, it's how much? 5,000. So 10,000 minus 5,000, I'm left with a balance of 5,000. I still need to go to year four and subtract 5,000, and I'm left then with 0. So it takes me 4 years to recoup. According to our criteria, we are not supposed to accept this. Why? Because the payback period is more than 3. So remember, previously we were told in the question that the payback period is not supposed to be higher than 3 years. So now, which projects should the company accept, and why? The company should accept neither of the projects, because project A has a negative NPV and project B has a payback period of more than 3 years. I'm done. So we're not going to accept any of the projects because of what we were told earlier.
Imagine it's just like this.
But honestly, if it were like this, I would get a 50 definitely.
You see?
A 50.
Let us calculate.
More than that. More than that. You get more than 50%. Maybe Madre should also tell us, if you were to sit for this exam, how much do you think you will get? She will give us an answer.
3 capital budgeting questions, right?
Yeah. Yeah.
So you are warranted for it. These ones will definitely get them right.
Yes.
Because for me, that one for the dividends, I'm going to get a 4 out of 15.
Yes.
For sure. And then you do your beta unlimited, not get it.
All right. Question 7 and question 8, they are not going to be touching on capital budgeting. right? Question 7 and question 8. Madre says I'll be getting 100%. Yeah, they are clapping hands for you, eh? All right. So question 7 and question 8, they are not they are not touching on capital budgeting, right? It's a different topic altogether. We can do it if you guys want us to do it, but there's an option to actually do it at a later stage. But I would encourage that maybe we do it at a later stage when your minds are fresh. Yeah, but what I want you to do now is I'm going to even send you more questions on the online platform that have to do with capital budgeting, so that you keep practicing and know that when you find any question in the exam on capital budgeting, your marks are guaranteed.
65% on the dot with this question.
You'll get that, yeah. All right. So I think it's safe to end here, and then we'll continue. I'll let you know which other sections that we'll be dealing with. But for now, let's focus on capital budgeting. I'll even send more questions. Make sure that you log in online. You can actually get this video, right? Especially on areas that you might not have understood. You go replay. I'm also going to upload these slides on what is it, on that platform, so you can also go and refer. But for your time. This was actually this is actually my first class where I'm attending both to guys that are presently here and guys that are abroad. All right, but thank you for your time. We have a question from Lebu.
Arthur, I just wanted to ask, is it possible that like for the exam, if you can like maybe compile like a document of all possible formulas? You know
Yes.
what I mean? So
She's
that,
asking what you've already asked.
Okay.
oh yes, because yeah, I'm like, because you see that, like, I know it's for us to know when to apply the formulas, but sometimes I'm just thinking, you know, if you don't even know where to find the
Yes.
formula,
Yes.
at least if we know this is like possible formulas, then it's for us to know, okay, this one goes there. Well, yes, like a formula sheet. These EAAs and ABs.
All right. So yeah, you can actually compile your formulas together so that you can easily locate them and know which one to actually apply at a given. Like for example, if you see anything that has to do with EAA, you know, oh, this is the formula I need to apply, and you don't need to be digging it,
Yeah.
elsewhere and all of that. Yeah. But
But what he was asking is that if
Are you able to do that?
yeah, I can actually do that.
Yeah.
I can actually do that for you guys, and then you are able to apply those. But otherwise, thank you for your time. Let's meet again next time.
Andre, next week, see you.
At 10 o'clock, my half past 10.
Yes. Yeah, next time let's meet exactly at 10 o'clock.